Mr. Taleb, I'm Officer Presbalewski from the government, and I've got some questions I'm going to need to ask you, some pictures I'm going to have you look at. All right? Sounds fine with me. Okay. This picture here, is this a black swan? No. All right. Now this picture, this is a black swan, right? No. Now this picture, is this a black swan? Yes, this was a black swan event. Don't you have a color printer? Yes, we do, but the ink, it's in the mail. I ordered it on Amazon. It's supposed to arrive today, but it didn't. It's been delayed, okay? All right, we'll do black and white today, all right? Now this one, is this a black swan? Am I a joke to you people? I'm out. I don't like your jokes. I don't want to be a part of it. All right, Mr. Taleb, I've had enough. You're free to go. No further questions. Hi, I'm Brandon. Welcome to Trading Mindset. Today we'll be discussing the possibility of the FTX collapse falling under the category of a black swan event and the strategy that may help you profit from events just like this. Although the phrase black swan was first documented in the 2nd century by Roman poet Juvenal, the idea of a black swan event was made famous in the 2007 publication of trader-philosopher Nassim Taleb's Black Swan, The Impact of the Highly Improbable. The term is used to describe events with the following 3 characteristics. 1. The event is a statistical outlier, highly improbable, and comes as a surprise. 2. The event is extremely consequential. And 3, the event is explainable after the fact, often appearing more predictable than it actually was. This theory quickly gained fame in financial industries, likely aided by the timing of the book's publication, April of 2007, just before the collapse of the subprime mortgage industry and the bursting of the United States housing bubble. It does need to be said, however, that Taleb claims that the 2007-2008 financial crisis was actually a white swan, or a predictable eventuality that was also rationalized after the fact. Now, the real question is, was the FTX collapse a black swan event? Let's break it down. First, was the event a statistical outlier? Did it come as a surprise? It certainly came as a surprise to many. There were those who predicted it, such as famed short seller Mark Cahodes, who documented FTX's shortfalls for nearly a year before the collapse. But to most, I'd say yes, it came as a surprise. Secondly, was the FTX collapse extremely consequential? Undoubtedly. FTX's collapse shaved off nearly $200 billion from the global market cap. Large cap coins fell by 15 to 25%, and FTX users collectively lost billions, not to mention the deterioration of trust in the entire industry. Finally, was the event explainable after the fact? Yes. Although the details of the collapse are still unfolding, regulatory and criminal investigations by authorities will provide their findings in the coming months. Or Sam Bankman-Fried will tweet an explanation. So, was the collapse a black swan event? In my opinion, the answer is no. Taleb once used the example of the COVID-19 pandemic. While the event was a surprise to most, extremely consequential, and explainable after the fact, a global pandemic had been predicted for decades by the likes of Bill Gates and Lori Garrett as an eventuality. Therefore, I can't imagine that following the collapse of Terra Labs, Three Arrows Capital, and numerous others just this year, that another collapse was perceived as impossible. So, how can one profit when a black swan event does occur? Taleb has us covered on this one as well. He coined an investment method, the barbell strategy. It comprises 2 distinct levels of risk, a large majority reserved in low-risk investments, think federal treasury bonds, and a minority of capital reserved in high-risk investments, think way out-of-the-money options contracts. I'll show you now. A way out-of-the-money options contract looks something like this. $5,000 strike price, $10,000 strike price, or $27,000 strike price. A strike price far from our current mark price. A way out-of-the-money options contract has a very low probability, but a very high payout in the event of a black swan. This ensures robustness, or protection from black swan events, and exposure to the profit they may provide. Thank you very much for watching Trading Mindset. Like the video if you learned something new, subscribe and hit the bell to be notified of new episodes. See y'all next time.